Unless you're living under a rock, when you're trying to buy a house, interest rates have skyrocketed. But what is hotter than Pam Anderson in the 90s right now in the mortgage interest rate market is what we call the 2-1 buy down, and our buyer clients right now are taking advantage of this very, very cool feature that lives on top of a loan. So you might be asking, what the heck are you talking about, a 2-1 buy down? Quite simply, a 2-1 buy down means you get 2 points of interest rate reduction for whatever the going market rate is right now. So in this video, what we're gonna do is we're gonna highlight some conceptual information, pros, and possibly some cons of the 2-1 buy down. Hey there, I'm Bob Friel, and I'm a licensed broker here in the beautiful state of Colorado, and I absolutely love helping people just like you with your real estate and mortgage needs. If this is the first time to the channel, welcome. What we talk about here is everything living, working, eating, playing, chilling in the beautiful state of Colorado, just living that Colorado lifestyle. Before we head to the meat and potatoes of the 2-1 buy down, go ahead and head down and like this video. Make sure you're subscribed and have the bell click for notifications when new videos are uploaded. So what we're gonna do is we're gonna give you some assumptions here. So we're assuming that we're gonna be buying a single family residence in the county of Denver, and a client is kind of wondering, should I put 10% down or 20% down? And then on top of that, the assumption is the credit score is 750 or higher, so that excellent credit range borrower. So a couple things that you'll notice on a 10% down or a 20% down loan just means that if you can put down a little bit extra at this point in time, as of the recording in this video, you would save slightly on your interest rate. So let's say the going interest rate's right around 6.25 or 6.375. Now you'll notice that the 2-1 buy down drops those interest rates down 2 percentage points. So what that does is it drops your interest rate for the first year 2 percentage points. Then it would go to 1 percentage point reduction in year number 2. If we get to year 3, your current note rate or the current market rate when you lock your loan would be what your payments would be reflecting in those subsequent years. So again, we are going to talk about some pros and cons. So clearly the pros here are, for the first couple of years, your monthly payments are reduced from what the current market rate would be if you were not to take advantage of this feature. The second positive is, of course, you can refinance at any time. So the idea with this 2-1 buy down feature is the banks and the powers that be are forecasting that rates kind of mellow out and chill out, or possibly get reduced over the next 18 to 24 months. Now, clearly one of the cons, in my personal opinion, is if rates don't decrease over that period of time, you as a consumer, as a home buyer, really have to have your budget in check, because after year 2, right, in the start of year 3, the going note rate of when you bought the property, so in this example, either 6.25 or 6.375, that's gonna be the basis of your payments. Now you may be wondering, how the heck do I get the reduced interest rate? Well, first and foremost, because this is a buy down feature, the government basically makes the rules that the buyer cannot pay for this as a feature of the loan. It has to come from concessions from the seller. The seller is paying the concession that's required to buy down your interest rate. And really the reason that we can do that is if you're prepared for 3, 6, 9 months in advance. The clients that have prepared for buying a property in spring and summer are the ones that are finding properties now in the fall and winter. Those houses are overvalued as far as what they listed at. So we're seeing price reductions, and because sellers are getting nervous, your preparation as a buyer allows our realtor partners to negotiate not only the sales contract price, which is ultimately first and foremost what you don't want to overspend on a property, and then secondarily, we're asking the seller for the concession cost to drop that interest rate. How much does that cost, you might be asking? Well, that's a variable factor of how much are you putting down, what's your credit score, and ultimately what type of loan are we getting. So that's a conversation for maybe one-on-one. So if you made it this far and you want to know the next steps, it's really simple. Check out the link in the description. We make it super ultra simple. There's a pre-qual certificate link that you can answer a couple questions in a matter of 1 minute or less, 60 seconds or so. That's going to spit out a pre-qualification certificate that the team and I can kind of look at in preparation for our buyer consultation. So what'll happen once you fill that out, Alex, our scheduling assistant, will look at your calendar, what you have available versus what we have on our calendar. We'll coordinate a time to do a Zoom chat. We have a little slide deck that we'll go through. That'll do it for the 2-1 Buy Down. If you have more questions, leave a comment so that we can address those directly. And even better, actually, just fill out the pre-qual form. We'll get on the calendar, get any questions that you have on your brain now, bring those to the table. We'll answer those in real time. We'll develop that action plan for you and snoop around the channel, get that brain growing. And as always, folks, stay sweet.